Hello, and welcome to the latest investment briefing brought to you by Gemini Asset Management. Today's topics are the Russian invasion of Ukraine and how this has affected asset markets, inflation and market reactions. Let's dive in. As I'm sure you're all well aware by now, there's been a war instigated in Ukraine by Russia. At the time of writing this, Western governments have condemned the actions of Russia in the most serious terms and imposed substantial sanctions, but they've yet to intervene militarily. This may prove to be a bit of a blessing for both markets and the world as we know it, but whilst we're of course sympathetic to the suffering that the war has caused, for the purposes of this video, we'll be focusing on the effects it's had on asset markets. Chart 1, on screen now, shows the performance of some of the main equity indices over the year so far. Somewhat unnervingly, the MSCI World, the S&P 500 and the FTSE All-Share are all above the levels they were before the war began. MSCI Europe and MSCI Emerging Markets also bounced well from the market lows in March, but remained notably down in the first quarter of 2022. There are two simple reasons for this. One is that we're still too early in the story to tell if there will be, or has been, any systemic damage to the global economy or financial system. Remember, not all market shocks start and finish as quickly as the COVID-19 market shock back in March 2020. Sometimes things take a little while to filter through the systems before we can understand their true implications. As was pointed out by Richard Berner, the clinical professor of finance at NYU, he was previously the chief US economist at Morgan Stanley and was a director who served on numerous economic bureaus within the Federal Reserve Bank in the US. Professor Berner said, "There may still be vulnerabilities lurking that aren't immediately evident, and we won't know their nature until the shocks expose them." The second reason why the equity markets may have bounced from the previous lows is because aside from the clear humanitarian, moral and political consequences, most businesses and people have still been able to operate with an overarching level of normality throughout the potentially world-changing event so far. Of course, energy price spikes, supply chain disruptions and economic slowdowns have all impacted, but so far these have not yet triggered a recession. As we've often said here at Gemini, we're buying assets and not economies. And during times of market economic stress, and when the risky bulls and the cautious bears don't have clear ideas on the certainty of their positions, assets can be volatile. And this is exactly what we've seen in the first quarter so far this year. But it doesn't necessarily mean destruction of value, as even during the tumultuous times, assets can still potentially appreciate in price. Just consider that strong market rally after the COVID crash. Now, moving on to the elephant in the room, inflation and its wider effects. Inflation's been a topic of frequent discussion in our investment briefings, as the causes and effects are so numerous that there's been a flavour of inflation in almost every single market story. It affects the relative attractiveness of returns for every single asset class, from equities and bonds to the houses that we live in, and even the more exotic assets like digital currencies. Inflation is a fundamental factor when determining if an asset's return is attractive or not. Chart 2, on screen now, shows the level of headline inflation in the US, the UK and the European Union. And as you can see, the levels are the highest they've been in decades. As we've mentioned many times in these videos, the reasons for these high levels of inflation are numerous, but they often just boil down to demand and supply dynamics. If something's in high demand and there's a low supply, prices tend to rise. And we see this in prices of various commodities these days, as Russia seeks to constrain the supply of key commodities to the rest of the world, leading to increased costs of production for businesses and consumers all around the world. This isn't necessarily too much of a problem, as long as the companies are able to pass those prices on to consumers. But with the increased talk of the cost of living crisis, consumers are now much less likely to be purchasing anything that they don't need. And this has been borne out in the consumer confidence figures throughout the quarter, shown here in chart 3, which is on screen now. Consumer confidence in the UK and the European Union is down near levels last seen at the height of the global pandemic, as the cost of living rhetoric and reality start to bite. This all just leaves one very important question. Is there any good news out there? Well, yes. The good news is that we haven't yet fallen into a recession, and there are some financial signals in some key markets which suggest that financial stress has not yet become unmanageable. Chart 4, which is on screen now, shows the spread between the US high-yield bond market and the short-term US government bonds. The spread's just a term that describes the amount of yield a bond is offering over the risk-free short-term US government bond yield. As you can see, typically in times of financial distress, the yield on the US high yield bond market skyrockets as investors ditch the riskier assets and seek the safety of the government-backed bonds. This means that the risky high yield bonds have to offer even greater yield just to attract investors. At the time of recording this video, the war, the multi-decade high levels of inflation, poor consumer demand and increased production costs for businesses haven't yet heavily impacted the investor appetite for the high yield bonds, and indeed equities, with both asset classes seeing positive flows of assets. As uncomfortable as it may be to admit, at Gemini, our crystal ball works no better than the next investors. So, whilst we too don't have a complete certainty on a direction of travel for markets, we can lean on the tried and tested investment practices that have served us well through other times of extreme uncertainty. The crux of this is effective diversification of multiple asset classes and across multiple regions, which has allowed us to ride out some of the market storms of the past by essentially not having all of our eggs in one basket. At the moment, we're exploring options to further diversify the portfolios, so there are more types of assets which may produce a positive performance, but also potentially spread the risk of any single asset negatively affecting the portfolio. That's all from us here at Gemini. Thanks for taking the time to join us, and we'll look forward to seeing you again soon. Thank you.